I do have an econ degree, but I'm not a financial advisor. If you need more help, definitely seek out professional advice, although they might try to steal your money. Hi, I'm Ellie. I'm a research fellow here at Taiwan NextGen Foundation. And who are you?
Hi everyone, and I'm Azim, and I'm an intern here at Taiwan NextGen Foundation.
We love our interns! Okay, so today we wanted to share with you this little vlog just to tell you a little bit more about what's going on with GameStop and why you should care. And maybe most importantly, why it's relevant to people here in Taiwan.
Right, so we'll be focusing on three things first. First, we'll talk about the main actors within the controversy of GameStop, and then we'll basically get into a bit of the technicalities.
And thirdly, we'll talk about the takeaways that you and I should care about from here in Taiwan. So, Azim, you mentioned the characters that matter in this story, and I think there are three of them. Why don't you tell us about the first?
Right, so the first character we have is Wall Street Bets, and as Wall Street Bets, the name suggests, it is a place where young people who have side cash to spend engage in aggressive trading behavior. And as a result, I guess one main attribute or characteristic of this group of people is that they're not afraid to lose their money, so which is why they can engage in aggressive trading behaviors.
That makes so much sense. Why don't you tell us about the second character?
Right, so the second character is Robinhood. So Robinhood is a trading platform where people can buy stocks of various kinds, and GME, so the stock that we're talking about today, is one of the stocks that is very popular on this platform. But then since the price hike of the GME stock, Robinhood has restricted trade on this particular stock, which as a result has drew condemnation from the Congress, from Senate members, but then also in general mainstream media and online, netizens.
Yeah, we're going to talk about the politics of that in a little second. The last key player in this story is going to be the hedge funds. So hedge funds have a pretty nasty reputation sometimes for being rich people looking after money on behalf of other rich people. That can often be true, but also they're the amalgamation of pension funds and teachers' pay, and it's really just a place where people get paid to look after other people's money. Oftentimes, hedge fund managers get paid quite a lot, and especially the people who own the hedge funds are more often than not millionaires or billionaires. So, yeah.
Right, Ellie, so tell us a bit more about the technicalities of this entire controversy.
So, essentially, once upon a time, there was a stock called GameStop. Now, GameStop is a company in the US that sells video games, consoles. In 2021, we don't particularly think of GameStop as being the next super sexy, exciting stock to buy. So many hedge funds were doing something called shorting the stock. That's when you expect the stock price to actually fall. Azim will tell you a little bit more about that in a second. Wall Street Bets, though, came on to this stock, and they realized that even though GameStop may not be the sexiest of companies, it still had pretty sound financial information, so there was no reason to think that the stock price would fall. So what Redditors did was they came together and they said, let's all work to buy the stock together, and that, we know with supply and demand, once everyone shares their increased demand for a good, the price goes up. So GameStop's price dramatically increased in value. Because the hedge funds had bet against GameStop doing well, they ended up going out of business. Not all of them, just one in particular called Melvin Capital. It's caused this big drama because here are young individual investors who don't have the institutional clout that many of these big banks do, who are coming together to actually really make an impact in the stock market.
So, as what Ellie just told us, in extension of what she has said, shorting is a practice where basically you expect the price of stock to fall. So what you do basically is you immediately borrow a stock from someone who actually owns the stock. Then you sell it at that price point. But in the future, you expect the price to fall. So when it falls, you then buy the stock back again and return it to the person who originally owns that stock. And then you basically profit from the margin. Mm-hmm. But shorting might sound heinous, but Ellie, could you briefly tell us why shorting might be actually a good thing for the economy?
Absolutely. So, like Azim said, shorting is about the expectation that a price of a stock is going to fall. But actually, this can be a great way to hold companies accountable for their actions. If you know, for example, that a company is engaging in risky behavior, you can openly short the stock, publish a really scathing report online or anywhere that you feel is necessary, explaining why that you believe this company is not going to do well, and then everyone can know that the company is engaging in risky behavior. So actually, stock shorting isn't all bad, but I think what makes shorting such an interesting aspect of this particular story is something called a short squeeze. So, what's a short squeeze?
What is a short squeeze?
So, a short squeeze, as Azim mentioned, when you short something, you borrow the stock, and when you borrow the stock, you have to pay interest on that stock. That means the longer you hold the stock for, the more interest you pay, right? So at some point, you have to buy the stock back that you borrowed in order to sell the stock on to get rid of the short so that you can close out your position and stop paying interest. If you imagine that, let's say the stock has started at $10, and you expected the stock to fall, but it's actually increased the price. Now, it's maybe a week on, you've been paying interest for a week, the price is now $15, right? But your lenders, obviously, the longer that you've been paying interest, the more you have an incentive to close out your position and stop paying interest on the stock that you borrowed. So eventually, at some point, you're going to be forced to buy the stock back at that $15 price point in order to return the stock to the person you borrowed it from at $10 a week ago, right? Let's imagine you're now Melvin Capital. You've borrowed hundreds of millions of dollars worth of GameStop stock, right? And you're paying interest on that stock. Now, all the Reddit army has bought the stock, and they've caused the stock's price to increase dramatically. So now you're paying interest, much higher interest than you expected on that stock. Suddenly, you're forced to buy back the stock that you borrowed in order to return it to the person you borrowed it from. But in doing so, you actually drive the prices up even more. Once the prices are driven up even more, your short position is even squeezed, and so you have to buy more stock because your interest has gone up. And so this creates a vicious cycle whereby you end up digging your own grave as an institutional capital investor. So this is one of the reasons why this particular situation is so fascinating.
So I'd like to thank Ellie for her very insightful contribution to our conversation. So in our last portion of this vlog, we actually talk about some takeaways. So what can you actually learn from this event? Mm-hmm.
So one thing that we were expecting is some legal action against Robinhood. I personally think this doesn't make sense. Robinhood technically didn't break the law by stopping people from being able to buy GameStop. You can buy stock from anyone you want. What happens is there's a time lag between when you buy the stock and when you have to, when that stock is actually that asset is transferred into your name. Essentially, Robinhood was borrowing money in order to be able to help people conduct those trades. And because of this time lag, they ran out of money to borrow. So that's why they closed their doors. Technically speaking, it wasn't anything nefarious, at least so we think.
So Ellie, I heard that you have a degree in economics. So as a prospective investor in the future, could you please tell us how can we responsibly invest in the stock market?
Absolutely, Azim. And let me just clarify, I do have an econ degree, but I'm not a financial advisor. If you need more help, definitely seek out professional advice, although they might try to steal your money. I'd say that there are two important rules that you want to keep in mind if you decide to invest in the stock market. The first, perhaps most important, diversify your assets. What happened to Melvin Capital is they put all their eggs in one basket. So it meant when that basket went awry, they were kind of screwed. If you instead invest in assets like index funds, for example, the S&P 500, the NASDAQ, Dow Jones, these are actually compositions of hundreds of well-performing companies. That means that if one company doesn't do so well, you have other companies in your portfolio that can balance out those wins and losses. Overall, you're going to be making a net gain, although it's not a get-rich-quick scheme to diversify your assets, but neither it should be. The second key important rule, buy and hold. Don't try to game the market. I'll tell you a secret. 90% of hedge fund managers who spend 15 to 20 hours a day researching stocks, understanding companies, investigating investment strategies, do not beat the market on trades overall. Sure, they might make some big wins, but I can guarantee that they'll make big losses too, which will outweigh and erase those wins in the long run. So make sure you just buy a diverse set of index funds, hold on to them, and over time, I can almost guarantee that you'll make a higher interest rate than what you're getting on your savings account just now, although you won't become a millionaire overnight.
Lastly, we hear the phrase, we're gonna shoot for the moon and we're gonna shoot for the moon and we're gonna hit the moon on Wall Street bets. Unlike what Ellie is telling us here, she's telling us to invest responsibly, and those on Wall Street bets, not so much, which is why for them it's either go big or go home, and most of them actually do have to go home. So in general, thank you so much for watching up until this point. And if you have any questions, feel free to leave a comment below and tell us what you would like to hear next from us.
Again, make sure to follow us on Facebook, Twitter, and Instagram. We are at NextGen Taiwan. And yeah, leave us a comment. Let us know what you thought. We're so happy to have you. All right, bye.